Thank you, everyone, for joining us once again. This is one in a series of Zoom webinars that we've been doing since the pandemic, and we've tried to switch the topic up a little bit. This is something that I think a lot of people are interested in hearing more about. I get a lot of questions. A lot of clients are calling me, asking me, what I should be doing in light of the fact that there's an upcoming election and how that could affect estate planning. And the answer is it may significantly affect estate planning. So it's important that everyone understand the landscape here. It's also, the phone's ringing. It's also important to understand where we're coming from, the context of this presentation. We're not going to get highly technical here. We're going to talk about the basic estate tax landscape, what different estate tax concepts mean, and then what the different outcomes of the election could do to that estate tax law and how it might affect you as a taxpayer. So, we're not going to get super technical for accountants or financial advisors or anyone like that. Certainly welcome to look on, and we're going to welcome questions. I've got a full agenda, and I've got a very esteemed panelist here with me today, who I'm gonna pull up Avi's bio, but I asked him to join us because he's a financial advisor that I know for a long time and respect. And he's got his own insights into what his clients are talking about and the different issues that financial planners are facing and talking to their clients about with relation to the upcoming election. So welcome, Avi.
Thank you very much for having me.
Our pleasure. Avi,
it's an honor.
Yeah, he's a I have this long bio from his basically from his website. I'm just going to skip to the parts that I like. He's the co-founder and COO of Inspired Wealth Strategies. So he's got a partner, and they are the principles of Inspired Wealth Strategies. Works with a lot of high net worth clients, a lot of insurance planning, a lot of sophisticated estate planning strategies, pension strategies, retirement work. Really a top-notch financial advisor, and we've worked with some clients together, and I have a lot of respect for Avi.
Thank you.
I'm going to skip to the most interesting part of the bio. Avi plays golf. We've played golf together, and watching the Knicks and Rangers. So we were just talking about that. If you guys tuned in early, I happen to be a big Islander fan, so I've been continuing to enjoy playoff hockey. But Avi's season ended.
We got the first pick, so no complaints.
And Avi is living in Manhattan. Are you in Manhattan now?
Yeah, we're on the Upper East Side, still here. It's definitely different than it was 6 months ago.
Sure.
We'll see where the future brings.
Yeah. Well, our firm,
everybody's packing out. I'll tell you that much.
Yeah. Well, our firm, for those familiar, I think most of the people on this webinar will be. Our firm is a real estate firm first. We do a ton of real estate transactions, and I hear from my partners that we're, certainly there are people moving out, but there are people moving in too. There's not like a flood of inventory in the city. I think there are some people that are, based on changes are leaving, and I think there are people that are coming in. So, I think the tales of New York City being dead are probably way premature.
Yeah.
And we certainly hope so. So I'm going to first, we're going to put up a little poll question. I always ask this question because I just want to have a sense for who's on our webinar today, just relating to your personal estate planning. So Oliver, if you could throw that poll question up, just want to know who here has a will. Now, when I say yes, I mean yes. You've done your estate planning, and you feel like your documents are good and they reflect your current wishes, and you've taken care of that. Yes, but outdated. I did a will at some point, but I know I need to update or change it. I'm not on top of my estate planning. Or no, never did a will. Know I need to do it, but just haven't gotten around to it yet. So just if everyone could just click in, answer that question, just gives me an idea of the kind of the level of the audience. All right, let's see the responses, Oliver. Okay, so yeah, I mean, this is pretty true to form. Usually, when you add up the outdated and no's, it's roughly 50% don't have adequate estate planning documents, and almost half of you do. So it's good to know. So some of you have had a background and have presumably heard some of the things that I'm going to tell you about. Let's jump right into my slides. I'm going to share my screen here, and let's do that. Okay. Avi, can you see my slides there?
Yep.
Okay, perfect. So just want to lay down some basic concepts, because I think there's a lot of confusion that surrounds the estate tax. And people will call me that have very few assets, very small estates, and they're concerned about my children are not going to get their inheritance because there's going to be a big estate tax. Obviously the estate tax exemption is high, and it's gotten higher and higher. When I started practicing over 20 years ago, the estate tax exemption was under $1 million. So where you had really any assets to speak of, you had a little bit of federal estate tax to pay. That exemption has increased and increased and increased over the years. I'm going to bring up a little spreadsheet to illustrate that, to the point where unless you're wealthy, you really don't have federal estate taxes to worry about. And to a degree, even the election going one way or the other probably won't affect that too much. You need to have millions of dollars to be concerned with the estate tax. But you'd be surprised how quickly those assets add up, because when you look at the the value of your home, the value of your retirement account, the death benefit of your life insurance policy, assuming that you own that policy and you haven't transferred it to a trust, those amounts add up, and all of a sudden, someone who doesn't feel particularly wealthy has an estate tax exposure. So something to think about. So the federal gift and estate tax exemption is sometimes called the unified credit, and it's the amount that you can pass. Is why we call it a unified credit, either during your lifetime via gift or upon your death via an inheritance, free of federal estate tax. So there's a set dollar amount. I'll show you quickly the little spreadsheet I have here. So you see, this starts in 2011, but it went up from under $1 million to $1 million to 2 to 3 to 3.5, and then by 2011 we were up to $5 million per person. The New York exemption was still at $1 million per person. We'll talk about the New York exemption a little bit, and you'll see it crept up over the years through 2017, when the Tax Cuts and Jobs Act was passed, which essentially doubled the exemption. And that should give you a sense for where Donald Trump's mindset is with regard to the estate tax. I think the first goal was to completely repeal the estate tax. Weren't able to do that. Then the idea was to greatly increase the estate tax permanently, and they weren't able to do that either. And that was with a Republican-controlled Congress and a Republican president who was very aggressive about eliminating estate taxes. So this increase in the exemption to 11.18 million, currently 11.58 million for 2020, is temporary. So even now, the exemption is set to reduce back down to around 5.9 million at the end of 2025. So this relief is basically temporary, and if anything, things have shifted a little bit to the left. So it seems unlikely that there'll be a permanent repeal or a permanent setting of the estate tax exemption this high, but we can't say for sure, and we don't know what the election will hold. So yeah, it could go in that direction. Just going to go back. So that unified credit, that 11.58 million, and now when you're talking about a married couple, if we've got correct estate planning documents in place, you can get use of 2 exemptions and use them correctly and basically shelter almost over $23 million from estate tax. So, you know, we'll talk a little bit about that and the idea of who the estate tax actually affects in a minute. But that's not to be confused with the annual exclusion gift. And Avi, I'm sure you get these questions all the time from clients, right?
Yep.
How much money can I give away without having to pay tax? You want to tackle that for a minute?
Sure. 15 a year per beneficiary.
Right.
So husband and wife could give 30. You know, if they have 3 kids, it's 90,000 a year, let's say.
Right. So you know, the thing about that I think confuses people is they confuse that with the idea of having to actually pay gift tax.
Right.
Or that their beneficiaries are going to have to pay income tax on what they're gifted. That is not the case. So you can make those free $15,000 gifts. You and your spouse can give $15,000 each to each of your kids and each of your grandkids and every stranger that you meet in the street. Those are like free gifts. You can do them every year, and they don't affect your unified credit. That's the only significance of that $15,000 number. You could say, you know what, I'm going to give each of my kids $1 million this year. Totally fine. There's no gift tax to pay. There's no income taxes for your kids to pay on the gift. It's free. The issue with that is that you're using up some of your unified credit. And for those that don't have huge estates, it's not a big deal. So where I have a client call me and they have, you know, $1 million in total assets, they're concerned about, you know, gifting their child $100,000 toward the purchase of a house. I say, it's fine. Go ahead and do it. It doesn't matter. You're not going to, you know, run into a situation where you don't have enough unified credit. Make that gift. Your accountant will file a gift tax return at the end of the year, reporting that instead of having $11.58 million of remaining exemption, now you have $11.48 million of remaining exemption. For someone that has $1 million, that's unlikely to ever present a problem. And nobody has to pay tax on anything. It's just keeping track of the use of your unified credit. If you make those little $15,000 gifts, don't even need to report it. Doesn't come off your unified credit. You make a gift in a year that's larger than the unified credit, you just have to report it, use up some of your unified credit, and you're golden. Okay, so that's
Jordan.
Yeah, shoot.
I have a question for you. We pay taxes as we earn money, as we invest money, and as we buy things. So why is there an estate tax? Why is there, you know, why can't I just give all my money to the next generation?
That's an excellent question. And that is, I think that is the argument that's made on the conservative side to say these are post-tax dollars. You shouldn't have to pay taxes again. This is akin to a wealth tax, just easier to compute. And it's a good argument. And I, you know, my goal here is to not even get my personal politics, not even let them show through in giving this presentation. But you know, that's the argument against an estate tax. The argument for an estate tax is that it's really, truly the most progressive type of tax, right? So where you perceive there to be an imbalance in, and this is all tax policy, an imbalance in wealth, you know, wealth inequality, right?
Right.
The 1% has so much more, you know, and it's so disproportionate, and there are multi-billionaires out there that have more money than 100 generations of their family could ever spend, and they should be paying their fair share of taxes. You know, this is a way that you can affect only the top 1%. It affects, you know, I know this is a buzzword for some people, but it affects some type of income redistribution where more tax dollars go in. Now, the way the estate tax is structured today, the exemption being so high and it affecting so few people, in the scheme of the revenue that is generated in the United States by taxes, it's really minuscule. And some have argued it's not worth having an estate tax because it's not worth the cost of enforcement.
Right.
Right. You know, they've got to audit these returns. They've got to review these returns. They've got to, you know, collect the tax. They've got to have a whole mechanism in place for having the tax. But, you know, I think, the idea of the ultra wealthy paying their fair share is a compelling one, especially on the more liberal side of politics. And that showed where there was some significant resistance, even toward the middle in the Republican Party, to completely repealing the estate tax altogether. But not to derail the whole thing with politics and tax policy, but I actually wrote an article because I found it so interesting that when politicians are looking to attack the estate tax, they're always invoking the farmers, the poor family farmers, and you're making them sell the farm if you make them pay estate tax. And there are statistics, I actually have one in this presentation, that shows that like no farms pay estate tax. It's the donor class. It's the people that are making contributions to politicians that don't want to pay estate tax because they're billionaires, and trying to get that exemption as high as possible or eliminate the tax altogether so that they can maintain as much wealth as they can. Whether they're entitled to do that or not, that's a matter for your own politics. But that's a long answer to your short question.
Thank you.
So now the New York estate tax, many states don't have estate tax. New Jersey doesn't have an estate tax. Florida doesn't have an estate tax. So people will often relocate if they have taxable estates after they retire, and part of that would be to result in a tax savings for state estate tax. I showed you the exemptions before. New York's exemption is now almost $6 million, and anything above that gets taxed, not at the same level as a federal estate tax, but it can actually get quite aggressive. If you actually go over that exemption amount by more than 5%, it's as if you're being taxed on $1 by New York. So, an estate of $7 million might end up paying almost, $700,000 or $800,000 in estate tax, because you're actually getting hit with a pretty significant tax. It's 16% max, last I checked, but where that cliff comes in, where you exceed it by more than 5%, at least in the early numbers, as you have a taxable estate, you can run into some disproportionate tax. So it's definitely a reason for planning, especially if you're in that range. And it's also important to understand, because I'm going to talk about this in presidential tax proposals, the idea of carryover basis versus stepped up basis. And it's very important to understand, because I have a lot of situations where I've had clients come to me after the fact, and they've made significant tax mistakes in trying to do their own estate planning, thinking that they were being helpful to grandma, and after grandma passes away, we realize that they've made a terrible mistake. When someone has an asset where they've got a lot of capital gain locked in. So grandma bought her house in Brooklyn 50 years ago for $30,000, and now it's worth $2 million. Grandma's got a significant capital gain. If she were to sell that house, she would pay some capital gains tax. She would have an exemption, because it's her primary residence, of $250,000 of capital gain, and then the rest she would have to pay a capital gains tax. If grandma dies with a $2 million piece of property, her estate's not big enough to pay any estate taxes. And when you inherit that property from her estate, you receive a step up in basis to the value of that property on her date of death. So you get all that capital gain is erased. You get a $2 million basis, sell the house for $2 million, and pay no capital gains tax. Some people decide it would be a really good idea, since grandma's getting old and we don't want to have to deal with probate, and we want to have to deal with lawyers, and it would just be a lot easier if grandma just signs a deed while she's still alive and transfers the house to son. Well, the problem is, when you're gifted something during your lifetime, you get what's called a carryover basis. You get grandma's basis. You don't get the step up. So now you own the house. Grandma lives there for a few more years. Now grandma dies, and then you turn around and sell the house. You've got a $30,000 basis. You're going to pay hundreds of thousands of dollars of capital gain because you didn't get that step up. And for what? You know, there's often good reasons for making gifts during life. Sometimes we're trying to protect against Medicaid, right? We want to shelter an asset so that grandma can qualify for a nursing home. So we might be doing planning in that regard. Maybe grandma has a $20 million estate and we're making gifts in order to reduce her estate tax liability. We're doing different planning strategies. And if we have time, we'll get into some of that. But, you know, grandma here has a $2 million estate, and making that gift was nothing but bad news. So just make sure that you don't try to do these things without guidance. Speak to your financial advisor, speak to your accountant, speak to your estate attorney before making any major transfers like that. But that step up in basis is very powerful. Even for the ultra wealthy that do end up paying estate tax, it's still really valuable to get that step up in basis and erase all of that capital gain. And that is also under attack.
That was my next question.
Yeah. So go ahead and ask it. I'll.
From what I've seen or heard, they may be getting rid of that. So, I mean, how accurate and how true is that? You know, can you see that happening?
Yeah, it is I have a slide on that, which I'll get to, but it is part of Joe Biden's tax proposal. You know, and look, these are just proposals.
Right.
But you've got to prepare yourself for the idea that some of these things might happen, you know, and you know, especially if we get a blue wave in November, right, where not only do we have a blue president, but we've got a blue Congress, you know, these things could become more realistic. You know, if things sweep all the way to the right, we could get a repeal of the estate tax. You know, I don't know if either of those things are extremely likely to happen, or if things kind of continue to be log jammed in status quo as they always are in Washington, or they always seem to be. But you know, it's something that we're definitely gonna talk about. So,
Jordan, one last question for you.
Yeah, go
on that slide. So I know we're going to talk about planning for, you know, the changes of the estate tax. And what people could do now, you know, in case the estate tax, you know, laws change. But for the step up in basis change, if that were to happen, is there anything clients can do now? I mean, if we gift, that's not going to work, right? Which you mentioned before. The only thing that, you know, would work is if grandma passes. So is there anything?
Don't get any ideas.
Nothing you could do.
Don't get any ideas about killing grandma.
So it's like 2010 all over again, right?
Yeah, I mean, it's you know, the only thing you can do is kick the can down the road, right? So you know, and some of those strategies are a question too. You know, in some cases, you might have a piece of property that's a piece of investment real estate that has a lot of locked-in capital gain. You want to get rid of that property, but you don't want to pay the capital gains tax. You could do something called a like-kind exchange, where a property is sold, and essentially through a pretty, you know, complicated, meticulous process, you identify new property and you swap the old property for the new, without having to recognize any capital gain. You still have your same basis, but now in the new property. So until you actually sell the property and take the cash off the table, you don't have to pay the capital gain. And in some cases, you know, grandma ends up doing the like-kind exchange. She gives up the house. You know, it's not her. Let's say it's an investment. It's not her house. She sells that brownstone in Brooklyn that she had tenants in that was an investment, and she buys, you know, a shopping center. And now she dies. We get a step up in basis on the shopping center.
Gotcha.
We did the 1031. We kind of kicked the can down the road. But if that step up goes away, it goes away. So I'm sure there are, you know, there's always strategies, you know, you guys with life insurance, and there's different things that you can always do to kind of convert an asset into another type of asset. You know, but yeah, that would be a devastating loss, not only for, even more so for the middle class, I think. And those with, you know, with some family assets, but not necessarily a taxable estate. It's a huge advantage to get that step up in basis. So maybe this ends up coming in where we don't get a step up in basis if an estate is over a certain threshold, or we only get a step up in basis, and this has been proposed in the past, on a certain value of assets. So we've got a $40 million estate. We can only get a step up on $10 million worth of assets. Right. And the executor will allocate the step up to the beneficiaries. I guess that presents a whole set of questions for, is the executor doing the right thing in making that allocation? Who are they being self-serving? That's a whole other trust and estate nerd debate for another day. But okay, so let's talk quickly about the Trump estate tax proposals, because they're pretty simple. Trump has said his goal is to make that increase under the Tax Cuts and Jobs Act permanent. Don't know if that is in the cards. I guess it depends on the outcome of the election. But I suppose if things shift further to the right than they were back in 2016, then they might have a shot at making it permanent. If not, there may just be the opportunity to extend it. Right now it's through the end of 2025, so that probably wouldn't occur under Trump, might occur under an ex-president. But if this remains status quo, then at least for the next few years, we know where we're going to stand. Is repeal still on the radar? Sure, there are a lot of people out there that are aggressively pursuing repeal, and I mentioned it. In my opinion, it's the donor class. It's the ultra wealthy that have dynasties that they want to protect, and they don't want to have to pay significant millions and millions and millions of dollars in estate taxes. I just put this little statistic up there because the farmer argument. Everyone who watches this can kind of snicker next time they hear that argument being made. Based on the current law, only 133 farmers in the United States would have any estate tax liability under the current law. So we're talking about 133 people in the United States if we're talking about farms. And if the farm is, if it's a husband and wife that own a farm, and that farm is worth in excess of $25 million, which is the current, their current available exemption, these aren't the poor farmers that you're seeing on the, it looks like those ASPCA ads. These poor farmers. These are mega farms that are highly valuable and profitable. So it's not farmers. But yeah, a repeal is still a possibility. I think it's probably unlikely. Here's the Biden-Harris proposals. Basically reverting back to where we were before the Tax Cuts and Jobs Act with regard to the estate tax. So we're going to, if Biden is elected, he would like to reduce the exemption back down to $5 million, which would be indexed for inflation as it had been when I showed you where it was creeping up year over year until 2017, $200,000 per year. If in 2021, it would probably be somewhere around 5.9 million, which is right around the New York exemption. That's where it was before the Tax Cuts and Jobs Act. So actually, this is saying 5.49 million or 10.58 million per married couple. I think that's a little bit low. Now, the prospect of that change is why I'm getting calls every day from my higher net worth clients saying, should I be doing some planning now, getting some property out of my estate while the exemption is high, using that unified credit for gifting rather than holding it and using it at death. Obviously, the trade-off being step up in basis. But should I use it or lose it? And that's a really good question. I have a lot of clients that are kind of poised to make a move. I don't know how we're going to get all of these transactions done on November 4th if this happens, but some people are sitting on the sidelines. I have a lot of clients that have asked me to prepare documents and get everything ready, and they're going to pull the trigger on November 4th, basically. But at least they have all the framework in place. There's a lot of clients that are doing something called slats, which is where you kind of you're hedging your bets by lining up a transfer that you're essentially making to your spouse. And if we have time at the end, we'll talk a little bit about that strategy. Maintaining portability. Portability is a relatively recent addition to the federal law that allows for the second spouse to die to get the first spouse's exemption upon death if the first spouse doesn't use it. So in other words, if I leave everything to my wife, that's an unlimited marital transfer. I'm not using my $11.58 million exemption. So I've essentially lost it. Well, it's because I gave everything to my wife. Portability allows my wife to make an election to take my $11.58 million exemption and add it to her own, so that when she passes away, she'll have my exemption plus hers. Biden has indicated that that would continue, which is good, and it makes sense. It really only punishes people who haven't paid attention to their planning. People who pay attention to their planning, for the most part, are not relying on portability. There's other more technical planning in place that kind of eliminates the requirement of portability in many cases. The federal rate for gift, estate, and GST taxes would remain at 40%. That's where it is right now. And that would be the change to the estate tax. But there's been some traction to plans put out by more progressive, more liberal, Democratic politicians like Bernie Sanders, which propose a reduction down to not a $5 million exemption, but down to a $3.5 million exemption, which is where it was a few years ago, increasing it to a 45% rate instead of a 40% rate, and then making that rate progressive. So as the estate gets larger, the rate goes up to 50%, 55%, and then ultimately for billionaires, every dollar over $1 billion gets taxed at 77%. So that's pretty devastating to families like that. But that is something that I guess could theoretically gain traction. And also keep in mind, there's no guarantees that these changes would not come about, and this is the reason for the panic, retroactive to January 1st, 2021. If Biden can get any of these types of proposals through, they could be retroactive to January 1st, 2021. Forget about the end of 2025 under the Tax Cuts and Jobs Act. That could all go away, and we could be dealing with a new rate and exemption amount effective January 1. So that's the panic to use the exemption now.
Got a few questions for you, Jordan.
Go.
Okay, so Biden wins, let's say, and let's say Congress becomes blue as well. How fast can they put this into law?
Yeah, well, I mean, it doesn't, I guess the bottom line is it doesn't really matter how fast they put it into law if they're able to apply it retroactively.
Okay.
To January 1st of 2021. I mean, the wheels of legislation in Congress grind slowly, and even in a steamroller situation, I'm sure it would take, the president doesn't get sworn in on the first, right? And then they've got to, Congress has to be in session. It's got to wind its way through. But if they pass something and they decide they want to make it retroactive to January 1st, there's definitely precedent for them to do that. They couldn't make it retroactive beyond that. But that's why it's important for clients that are playing with high stakes to get these transfers done before year end, rather than relying on the fact that as long as new legislation hasn't been passed, I'll be okay. In the interest of fairness, they might say, look, if you died in January or February, these rules are not going to apply to your estate. But there's still that possibility out there.
You answered my follow-up questions. The next ones were, can it be retroactive even prior to January, meaning this year? Can they? No.
Yeah, so I think that would be unconstitutional.
Okay. And the second question is, if clients do planning this year, is there any chance that they would not respect that planning and they could say, sorry, you did it knowing that this was going to happen, not good, or it goes back into your estate, etc.?
The answer is no, we don't think so. And I actually have a whole slide that's going to talk about that, which we'll hit in a minute. But the answer is no. If you do your planning now, you should be safe, which is which is a big thing. I'm actually going to tackle a couple of questions that were answered in the chat and the Q&A that were asked. And if anyone else has any other questions, feel free to type them in. I'll try to get to them as we go. If I file a gift tax return, do I need to record the money that was given as an annual exclusion amount? The answer is yes. If you're filing a gift tax return because you've made gifts in excess of the annual exclusion amount, you are supposed to also report in that year the annual exclusion gifts that you made as well. Now, they'll be deducted back off as annual exclusion gifts, so you won't be using your exemption, but you are technically required to report them if you're filing a gift tax return in that year. Does the gifter have to pay tax on the $15,000 given to the giftee? Is it taxed on income for the year the gifter gives? No, it is not taxed at all. If you're making a gift to the giftee, the gifter doesn't have to pay, or the transferor does not have to pay any tax. The recipient of the gift does not have to report any income tax. It's a gift, which is why we have this gift tax system in place, right? It's either income or it's a gift. So if if I give one of my employees $15,000 and I say it's a personal gift from me, that's fine. And if it's an annual exclusion gift, that's okay. But if it's compensation to my employee, then it's taxable. So, but if I gave I can't say I've given my employee a $100,000 gift personally. At best, I've given my employee a $15,000 gift, and the other 85 is going to come off of my available exemption. So, again, long answer to a short question. No, there's no tax due. And if I move to a state that has no estate tax, or one that is lower than New York, but you own real estate in New York, you still need to pay the New York estate tax. If you successfully relocate your domicile to another state, and that's an involved process. And if you're a high net worth client, New York really likes having you around, and they may audit you to make sure that you really have abandoned New York as your state of residence. But if you're successful in proving, or you're not challenged on the fact that you have actually relocated and you've got real estate in New York, then you would be subject to New York estate tax on the property that you own in New York State, or you could be subject to estate tax on the property that you own in New York State only, not all of your assets. Okay, so
Jordan, one last question for you.
Yep.
Unless you have more up there, but
no, that's all I have up there.
Okay, so it obviously makes financial sense to get money out of one's estate now, to avoid any potential, pitfalls down the road. What are some objections that you see from clients not wanting to do it, and how do you handle those objections?
Yeah,
and I know one may be losing control, of assets.
That's a big
children.
That's a big one. I mean, often I see this in the context of the family business, right?
Right.
The most valuable asset is an operating business. Family, manufactures widgets, right? And the matriarch or the patriarch of the family runs the business, and maybe the kids are involved and maybe they're not, but they're okay with giving equity of the company away and using that to try to reduce their estate tax exposure. But they don't want the kids coming to the table and voting and trying to undermine what they're doing or getting involved in the matter. That their philosophy is the kids are still learning, and they'll run the business when I'm ready to have them run the business. The way we often deal with that is we control what we're giving the kids. So we might take that company or that those real estate holdings, right? We've got a lot of real estate families that are, have a high net worth, and they don't want to give properties away. They just want to give equity away. We can recapitalize those entities into voting and non-voting interests. So mom or dad retains all of the voting interests, and they're giving away non-voting, non-controlling membership interests in an LLC or non-voting, non-controlling stock.
Right.
So essentially, they're just giving away pure equity. They're not giving that shareholder any control or any vote in the company business, which is important to them. The other idea is to try to figure out ways to address the potential estate tax exposure, often with life insurance. And that's where, you and I have talked about those types of strategies many times. Maybe you want to give us a little bit of, talk on life insurance as an estate tax.
Sure.
Ballast, I guess.
Sure. You want me to talk now or a little bit later?
Talk.
Yes. So the estate tax has to be paid, right? If there's an estate tax due and we haven't done planning, or we've done planning but not enough planning, it has to be paid. And the question is, how do we pay that estate tax? So we could pay for dollars, or we could pay pennies on the dollar, right? So if it's a real estate family, like you mentioned, or a closely held business, a lot of times liquidating the real estate holdings or liquidating the business becomes very difficult. So if we could find pennies on the dollar and create liquidity, generally that's a much better approach. So maybe the family has 15, 20, 30 buildings that they own now. Maybe we sell 1 or 2 today. We buy life insurance with those proceeds, get it out of the estate, and then we have liquidity so the family doesn't need to sell 10 to 15 buildings, later down the road. So we're doing a lot of that. I'm sure you'll talk about this later. Are you going to talk about grats later?
I don't know if we're going to have time.
Maybe a little technical, right?
Yeah. I mean, maybe just generally, but.
Yeah, so generally life insurance is, we get it outside the estate. We use the gifting, that Jordan spoke about. Could be $15,000 per person, per beneficiary. And then there's ways to get more using split dollar and, yada, yada, yada. But the goal is to buy policies outside the estate. Therefore, the life insurance proceeds are completely income and estate tax free, potentially, millions of dollars outside the estate to pay whatever estate taxes that are due, allowing the family, allowing the business to continue, to the next generation. So that's just a general concept, but obviously there's much more, we can go into much greater detail.
Life insurance can be a very powerful tool in dealing with estate taxes, where you don't want to have to, sell the family business in a fire sale, or sell a piece of real estate that you didn't want to sell in order to produce the liquidity to pay an estate tax bill. That's often what people are faced with. And there are other options. There are things you can work out with the IRS to pay it out over time, but often that's not an attractive option. So it's definitely something that we deal with all the time. I'm sorry.
Yeah, I was going to say 2 other really quick ideas. Stretch IRAs, which no longer really exist. So we have clients that have millions of dollars in IRAs. It used to be, to the next generation, they could spread it out over their lifetime. Now they have to do it over 10 years. So the challenge is, number one, it doesn't allow for the growth that you would have over a 30, 40-year period. But then number 2, you're taking much larger income from that IRA, which creates larger income tax. So what we're doing is we're having clients take the tax today, buy a policy, get it outside their estate, and that will be a much larger inheritance to the kids, which will be income and estate tax free, versus an IRA, which will be subject to income and estate taxes. I'm sure you've seen that.
This is a big thing that's going on right now. I think the Secure Act and that change to eliminating the stretch IRA didn't get the press that it deserves.
Yeah, and the last thing, which is technical, but considering the low interest rate environment, we're seeing a lot of guys and gals, families, generally in the financial and real estate world, premium finance. So we have clients that have assets, and they are earning a good amount of money in those assets, whether it's private equity or hedge funds or real estate. They know they need the permanent life insurance. They know they need it for the estate tax planning, but they just don't want to pay for it, right? So and the sale is, you've bought your real estate by leveraging. What if we could leverage and use somebody else's money to buy the life insurance policy? So we're doing a lot of that, and I'm sure you've seen that as well.
I have. And those are excellent strategies to keep on your radar. As we're dealing with the changes in the estate tax. I want to talk about the concept that we started to talk about earlier on, which was the elimination of the step up in basis. And this is something that Biden has promoted. And there are similar systems all over the world where either there is no step up in basis, which is actually quite common. It's a great benefit, but it's kind of rare that you would get a step up in basis on death. And look, we talked a little bit earlier about how fair is it to have an estate tax when these are pre-tax dollars. Well, it's kind of, you can't have your cake and eat it too, right? So in this case, yeah, the assets are being taxed, but the capital gains are being forgiven. So maybe the ultimate answer to this problem where it becomes fairer is to say, okay, maybe there is no estate tax, but maybe we eliminate that step up in basis so that where the taxes have not been paid by the decedent, the taxes will eventually get paid and won't be erased the way they are right now with the step up in basis. So I think that's the idea behind this policy. I believe Canada has a similar policy. The question becomes, you see the first bullet point, is it an elimination of step up in basis where you get a carryover basis in the property and when you sell it, you pay the tax? Or is death a realization event, meaning when you inherit it, taxes due? You've got to come up with the money. You can inherit the asset, but you've got to come up with the money to pay that capital gains tax, just like you would have to come up with the money to pay an estate tax. IRS doesn't really care where you get it from. And that may end up creating another situation where life insurance might be useful in producing that liquidity if you anticipate a large basis step up in the future. But that would be a significant thing, because where are the taxpayers supposed to find that money in a hurry to pay that realization event when they haven't sold the property yet, especially if it's a very large capital gain that's going to be recognized. And we talked about most of the concepts here, but this is very much a part of Biden's tax proposals, the elimination of the step up in basis. It's interesting to know. Oh, and also that it may not be based on capital gains rates, because capital gains rates may be increased to regular income. So it could be, a 39% tax, which is effectively the same as the estate tax. So there's so many possibilities out there, but I guess the bottom line is you can expect if, at least from an estate tax perspective and probably from an income tax perspective as well, that under a Biden-Harris administration, there's going to be some additional pain for high net worth individuals in some form or another, whether that be an estate tax, a step up, elimination of the step up in basis, elimination of the preferential capital gains rates, some combination of those things. So we don't know. And then you see the last bullet point, and then I guess the remaining property would be subject after the tax is paid. You would assume they'll let you deduct the amount of the capital gain that would need to be recognized upon death from the value of the estate. So it's not double taxation, but then you would have to pay estate tax on that net amount once you've paid the tax. So it could be a double whammy. We're almost at an hour because we've covered a lot of info, and I try to keep this under an hour. So, but this is important. Sorry, let's hit this before I stop. You had asked Avi a very important question. People who do planning now, how are they assured that there won't be a clawback where they'll say, well, no, now the laws have changed and you don't have an $11.58 million exemption and you never did, so you're going to have to pay gift taxes or estate taxes. There were regulations that were put out by the Treasury Department assuring taxpayers that there will be no clawback. If the estate tax, just based on that sunset at the end of 2025, they were saying, if you use it now and then it's 2026, you'll be safe. If the laws change, that would still apply, presumably. So, if you make these transfers now while the exemption is 11.58, and then on January 1st, it goes down to 5.9 million or 3.5 million, you should be okay. So that's where that kind of use it or lose it mentality comes into place. And if you've got a taxable estate and you think that it's potentially realistic that we could be dealing with a shift to the left and some of these tax policies being implemented, I wouldn't wait that much longer to start entertaining using that exemption and making some smart, some smart gifts under the guidance of your financial professionals and your attorney while you still can, for sure. So, and these are some of the strategies that we're using in order to, these are tried and true typical estate planning strategies where we're using the exemption, whatever the exemption might be, to transfer wealth typically to the next generation. But the one that's really resonating right now is this technique called the flat, where you're basically creating a trust using your exemption for the benefit of your spouse. So the money is still in your household if you really needed it. I wouldn't recommend putting your last dollar in a slat or anything like that, but you're basically grandfathering in use of the exemption by creating this trust using your exemption for the benefit of your spouse, and then ultimately for the benefit of children or other beneficiaries. And it creates a hedge, but it does, there are a lot of aspects of it that need to be seriously considered. We don't rush into doing things like that. So, it really takes time to kind of analyze and make sure that it's the right strategy and understanding all the pros and the cons. But I can say we're doing a lot of this right now, a lot.
Jordan, quick question for you.
Yes.
A client listens to your advice and gets everything out of their estate now, or what's allowed to get out of their estate, but they still have another 20, 30, or $50 million in their estate. What other strategies, maybe just one or two, that you would recommend to try to freeze their estate or lower their estate or get some appreciation out instead of keeping it all in? Yeah.
So what's the asset that we're dealing with? What kind of assets do these people have?
Let's say appreciating real estate.
Yeah. So the idea is and we don't even have to talk about a specific strategy. Typically you're talking about where you're dealing with an asset like that, which is an investment real estate. You're typically dealing with something called a sale to an intentionally defective grantor trust, or
right.
Something called a GRAT, the Grantor Retained Annuity Trust. Tax lawyers love acronyms. But basically the overriding concept is we're trying to take interests in an entity. So let's say we have an LLC that owns a building, and we're trying to discount the value of what we're transferring, number one. And then we're trying to freeze the value of the asset. So let's say we have a building in Manhattan right now. If we appraise it, the value of Manhattan real estate is probably a little bit down right now. So that's good from a planning perspective, right?
Yep.
Also, interest rates are low. A lot of the strategies that we use are based in low interest rates are the most desirable. And we're able to take those assets, which are already depressed in value. We're giving away non-voting, non-controlling membership interests in that LLC. So we're able to discount it because those interests, who would want to buy it, right? If I say, Avi, I'm going to sell you a 30% interest in this building that I own, but you can't vote, you can't sell it, you've got to be my partner and do whatever I say, and you've got nothing to say about it.
I want a discount for that.
You're not going to pay me 30 cents
right.
On the dollar. You're not going to pay me what 30% of that property is worth. You're going to say, I want a discount. Usually those discounts are between 25 and 40%. Right. So we take this value of this $1 million of real estate and we say, okay, it's not worth $1 million, it's worth $650 because it's discounted. And now we're going to put it in. So we're freezing it. So now when New York real estate comes back and that $1 million interest is now worth $3 million, we've frozen out all of that growth and appreciation.
Yep.
Right, it's gone. Plus we got it out of the discounted value. Plus if I'm buying it rather than using it as a gift, I'm using these low interest rates. So that's the overriding strategy in these types of transactions. But, I guess bottom line is, although it's a bad time for a lot of things, from an estate planning and valuation perspective, it's really an ideal time.
Right.
The exemption is high, the interest rates are low, the values are depressed. It's kind of a winner on all sides to do your planning now if you're inclined to do planning now. And I'll tell you, a lot of clients are right now with the uncertainty of that upcoming election, kind of circling back.
Right.
If anybody who needs to go, obviously can jump off. There's a couple of questions up here on the Q&A that I'll try to tackle, and then we'll call it a webinar. Are there ways to gift but maintain control or get money back if needed? Not really, but yes. So if we're doing a slat, right, the spouse is the safety valve. So as long as the spouse is still living, the trustee could make distribution to the spouse to get the money back into your household. The problem is, first of all, those would be the last dollars that you would want, because hold on, let me stop screen sharing. Those would be the last dollars that you would want. I already did. Okay. Because you've already used up exemption to get them out of your estate. Why do you want to bring them back in? Number two, it's kind of frustrating your estate planning. And number three, your spouse still needs to be married to you and alive in order to get that benefit. But that's one strategy. The other strategy is other types of trusts. Yes, the trustee could theoretically decide to lend you money or assets from the trust in exchange for a promissory note. You will have to pay some rate of interest. It's got to be kind of an arm's length type of thing. But yeah, they could. The kids could make distributions to themselves if they're beneficiaries. And then if they voluntarily decide to make a gift to you, using up some of their exemption, they could get the money back to you. But it's, I tell clients, don't go into these types of transactions with the idea that they're reversible and that there's no harm to be done if you need the money back. Don't let the tax tail wag the dog. If you're uncomfortable with making these transfers, because you feel insecure about what you're leaving yourself with, don't worry about the tax so much. Make sure you're comfortable. You've earned this money. You should feel comfortable and not affect your quality of life by doing this type of planning. So definitely something to be aware of. These are okay. Living trust. Can I purchase a home with money from my 401k? That's kind of outside the scope of the presentation. I would talk to my accountant about that. There are some COVID related distribution avenues that you might go down, but that's kind of outside the scope. If a son is a member of an LLC, owns a property, and the parent dies, does the son lose his ability to sell at the stepped up value upon the parent's death? That is, if the son is a member of an LLC, owns a property, and the parent dies, does the son lose his ability to sell at the stepped up value? So that's actually probably a more sophisticated question than you even might realize, because when you're dealing with real property that's owned inside an entity, there's something called inside basis and outside basis. And there are elections that are made to adjust the basis of the real property to the value of the LLC interests. So again, I'm going to kind of punt that question to your accountant, depending on circumstances, but the answer is you probably can get the step up in basis, even though the asset is held in an LLC in most cases. And lastly, can you gift part of an IRA? You can, but it's still income. You're still going to, whatever you take out of the IRA and distribute to yourself, you're still going to have to pay income tax on it. There's no way around that. So you can take that money, pay income tax on it, and then gift the net to your beneficiaries if that's what you want to do. Really not if you're either you're over what is it, 70 and a half, Avi, or is it 70?
I think it's now 72 or yeah.
Yeah, but you can take distributions after what, 59 and a half?
59 and a half, yes.
Right.
Yeah.
Right. So really no worse than if your child inherits that IRA, because they're not getting a step up on the IRA. That's an asset that does not receive a step up in basis, because no tax was ever paid on it in the first place. So, you know, you could do that, but just understand the consequences. And again, always consult with your accountant before you do something like that. And look, one more question here. I'm going to take it. If a surviving spouse transfers the marital home to a child during her life while retaining a life estate, what is the basis of the house when she dies? Marvin, excellent question. If a life estate is retained by the grantor, then the property is includable in their estate for estate tax purposes, and the beneficiary would receive a step up in basis. So in that example that I mentioned earlier, I'm just going to shut that question window. Where grandma wants to get the property out of her name because they want to avoid probate and they think it's going to be easier to do it that way. The answer is we'll usually do something involving a life estate, typically not just an outright transfer with a life estate, usually a transfer to a trust where grandma retains the right to live in the property. But by holding those strings, by giving grandma that life estate or the ability to live in the property for the rest of her life, it does bring it into her estate for the purposes of giving the beneficiary a step up in basis, at least as of right now. Of course, everything is subject to change after November 3rd. We'll all have to wait and see. So I hope this was helpful. Avi, you have any parting words of wisdom?
Sure. Yeah. I just wanted to add how imperative it is for everybody to review whatever planning they've done. I'm sure Jordan would agree, and I'm sure you've seen tremendous amount of planning that wouldn't fly today. So something that was done 15, 20 years ago, you know, if it's still there today, it just wouldn't work. Right. So it's imperative for people to review their planning and make sure that, you know, it's current with whatever laws, you know, are today. I'm sure you would agree with that.
It's a great point, because just looking at that table that I showed you where the exemption was increasing over time, a lot of people did wills back then thinking that the exemption was only $1 million or $3 million, and they were doing specific things with whatever that dollar amount was. They were never contemplating that it was going to be
right. And nowadays we build flexibility that if it changes, you're okay. Yeah, and the last thing I would add is same thing on the life insurance side. If anybody has policies, they should be reviewed. A lot has changed in that market. So, you know, people have variable policies, universal life policies that they bought in the 80s and 90s. They definitely did not perform the way they were originally illustrated at 8, 9, 10% rates. So a lot of them, a lot of the work that we do is auditing, and we do, you know, comprehensive audits, complimentary. We don't charge anything, but you'll see a lot of policies, a lot of owners, you know, they think that the policies are going to last and that, you know, they have a policy that will eventually pay out and, you know, be there for liquidity. But really 5 years from now, 10 years from now, they're actually going to lapse because they're not structured properly. So very important, you know, whoever you're working with, you know, to review those plans annually. If you don't have someone, I'm happy to help. Jordan has my number. Again, complimentary. We don't charge anything, you know, to do a review. And yeah, any way we can help, we're happy to.
In the chat right now, I'm going to throw up Avi's contact info right there. And I'll get your email address up there as well, Avi. So if anyone wants to contact Avi with a specific question or issue, please feel free to do so. You're also going to get an email from us with all of my contact info. Obviously, any questions regarding estate planning, estate administration, probate, any issues regarding you know, the estate of a loved one or anything like that, feel free to reach out. I'll be happy to try to answer any questions that you have offline. I hope this was helpful for everybody. I think we've said a lot, maybe too much. But everyone have a great rest of your day, and hopefully we'll see you on a future webinar.